All right, let's jump right in. We're going to look at two of the absolute hottest sectors in finance today, crypto and private credit. Now, on the surface, these two seem like they're from different planets. But as you're about to see, they share a very familiar and maybe a very dangerous secret.
So that's really the big question for us today. What's the invisible string that connects the super high-tech, wild world of digital money with the more, traditional behind-the-scenes world of private lending? The answer, it turns out, is a classic story from financial history.
To really get that answer, we first have to understand this idea of the regulatory perimeter. The best way to think about it is like a brightly lit room. Inside that room, you've got the regulators, like the SEC, and they can see everything clearly. Banks, public companies, they all have to follow strict rules about how much money they borrow and what they tell investors. It's all about safety and, making sure there are no secrets.
And this, right here, is where our story really kicks off. Both crypto and private credit are absolutely exploding, but a huge chunk of what they do is happening outside of that well-lit room. They're out in the shadows, where the rules are kind of fuzzy or maybe don't even exist yet. And that's exactly where risk can quietly build up, totally out of sight.
Okay, let's start with case study number one, crypto. Everybody knows it's a roller coaster, right? But the really scary part might just be the leverage that you can't see. So where exactly is this risk hiding? Well, first, you've got these super complex things called perpetual swaps, which basically let traders make massive bets with borrowed money, and there's very little transparency. Then, a lot of this stuff happens on these opaque offshore exchanges. They don't have the same strict rules as, say, the New York Stock Exchange. And finally, you have stablecoins, the things that are supposed to be the safe, stable foundation of the whole system. They claim to be backed one-to-one by real dollars, but whether those reserves are really there, well, that's often a big mystery. And that brings us to the key word here, opacity. It's just a fancy way of saying it's a black box. Nobody, not investors, not regulators, not even other people in the market, can see the full picture. You can't see how much debt is really out there or what's actually backing it all up. And when you can't see the books, there's no way you can accurately figure out the risk. Okay, now let's pivot. We're going to move to a totally different world. Or is it? Let's talk about private credit. This is a massive, booming industry where funds lend money directly to companies, completely bypassing the normal banks and public stock markets. And believe it or not, just like in crypto, the risks here are built into the structure. We're seeing this huge boom in things called CLOs. Imagine taking a bunch of different loans, tossing them into a blender, and selling off the smoothie. It becomes really hard to tell if any of the individual loans inside have gone bad. We're also seeing more and more covenant-light loans, which are basically loans with fewer safety nets for the lender if the company starts to have trouble. And on top of all that, these loans are really hard to sell quickly. It's a perfect recipe for risk to hide in plain sight. So when you put them side by side like this, it's shockingly clear. On the left, the crazy tech world of crypto. On the right, the buttoned-up suit and tie world of private credit. The tools they use are totally different, but the fundamental problem, it's exactly the same, opacity. In both cases, huge amounts of debt are building up in the shadows, hidden from almost everyone. Now, if you're starting to get this feeling of déjà vu, you should be. This isn't some brand new thing. This is a pattern, a story that has played out over and over and over again in finance. I mean, just look at the history. In the 80s, it was junk bonds. The 90s, it was over-the-counter derivatives. In the 2000s, it was the shadow banking system that led straight to the 2008 financial crisis. Every single time, some new innovation lets risk build up outside that brightly lit room, and every single time, it ends in tears. And today, well, that big question mark is hanging right over crypto and private credit. This quote just nails it. It says it all, really. Historically, regulators aren't fire marshals, they're the fire department. They don't show up to prevent the fire, they show up with the sirens blaring after the house is already burning down. Regulation is almost always a reaction, not a prediction. It's a hard lesson from history. So, if history is our guide here, what does this mean for these two sectors? What happens when all of this hidden leverage finally has to step out into the sunlight? Well, the playbook is pretty predictable. First, something breaks. You get a market crash, a big collapse, a moment of real panic that suddenly reveals all the risk everyone was ignoring. Second, the regulators are forced to step in and clean up the mess. And third, they expand the perimeter. They make that brightly lit room bigger to pull these new shadowy activities inside where they can be watched. So, the single most important thing to take away from this is that new rules for both crypto and private credit are coming. It's not a question of if, it's just a question of when. The pressure to bring these giant markets out of the shadows and into the light is just going to keep building until it's overwhelming. And that leaves us with the final and most important question. We see the pattern, we see the risk building. So the real uncertainty isn't if the rules are going to change, but what's it going to be? What's the specific event, the failure, the crisis that finally pushes the regulators to act? That's the billion-dollar question hanging over everything.